And gentlemen, good afternoon. I am a little bit, I don't know if I'm happy or surprised that so many of you have chosen financial stability lessons learned from 2023. Luckily, I have the best possible experts on telling us and taking us on that voyage. But indeed, if I look at the parallel sessions and I take the AI one as telling us what the next flying car will be, and I take the cyber and competition one as telling us what the next Ferrari will look like, very good that Santander sponsors them, by the way, tells you something about competition for growth, then this is the same session with the Volvo. And we did a little crash test in March. Because to set a little bit, to set the scene for you is the world held its breath. After 2008, in March 2023, we thought that the ball would start rolling again and we would see a major banking crisis that again started in the US and again in a way that was surprising for many. But was most surprising for me is that it then went from the US to Switzerland, where next to the European Union, we had a systemic bank needing to be supported by government and needing to be taken over in a very short time. So for me, I'm a big believer, I'm Wim Meijs, I'm the Chief Executive of the European Banking Federation, I'm a big believer in the banking union. I thought that after 2008, one of the great strides forward was to have single supervision and a clear rule book, and that has helped us. But now was the big test. We did a stress test, an artificial stress test, but apparently some people thought it would be good to do a real-life stress test. And we survived. I think that Europe has proven, the European bank system and its regulation and supervisors have proven to be pretty resilient. Nevertheless, there are many lessons to learn, in my view. Because if I just talk about SVB Bank, I wonder that if you look at the interest rate risk, which is about the first thing you learn in day one of your banking training or your economy studies, was not very well managed, to say the least. And then, of course, the call is always, did we have enough? Do we have enough regulation? So many politicians say it was not enough, let's regulate some more. But the way I always see that is that, yes, the regulation was sufficient, but it is a little bit like if you have a very beautiful guitar, if you don't practice, you still cannot play guitar. So you have the regulation, but maybe it should have been used a little bit more by our supervisors. And then what the lesson taken is, and this was the lightning speed with which everything happens, is the role of social media. So these aspects, and again, as I said, I'm very happy with my panel. I have Sheila Bair, former chair of the FDIC, and I think that the FDIC is an example in how to orderly resolve banks and a kind of hygiene factor. Maybe we'll talk a little bit later about that and how that differs between Europe and the Americas. I have Jose Manuel Campa, who was, of course, already introduced. I always have this endearing term for him. I always see him as the master of our rule book. Because the European Banking Authority, of course, is the rule book by which we all live, and indeed he's the chair of the European Banking Authority. And finally, member of the board of the Bundesbank, and who had actually had to deal with Deutsche Bank on, I believe that was the 24th of March, and who saw the influence of social media directly. Joachim Wurmeling, I'm very, very happy that you're here. And Joachim, to start immediately with you. You saw Silicon Valley Bank, and I've heard many central bankers make a quick analysis of what happened there and what should be done or what shouldn't be done. Then we saw Credit Suisse, but suddenly it was in your own country with Deutsche Bank. And in my view, it was an example of parties playing against Deutsche Bank, mostly in credit default swaps. But you also saw the role of social media. You saw I would say, very high net worth individuals move their money around. But here was something new for me, the term sticky deposits. Can you give a little bit of the overview of how you experienced that period, and also if you thought your regulatory instruments were sufficient?
Well, thank you very much for having me. Indeed, that was a hot weekend for the supervisors. And we were, of course, very scared that the crisis situation in the US and in Switzerland spilled over to the Eurozone. And we saw, indeed, some signs that of volatility in spreads in CDS. But finally, it was managed. Well, the crisis itself in the two institutions were due to a new level of pace in various respects. First of all, the spread of information via social media. Well, there was also information about or critical information about banks did spread also before social media very swiftly. So here it was the specific situation that a big concentration with deposits on the side of the Silicon Valley Bank. So it was very easy only to talk to a dozen of people to make that effect. That was due to the very specific structure of the client base of Silicon Valley Bank. But it was, of course, also kind of bad luck because at the same time the increase of the interest rates was significant and the inflow of deposits to Silicon Valley Bank. So three elements which came together which caused that crisis. The interesting or the worrying thing here is that all the capital requirements, all the ratios were met. Yeah, by Silicon Valley Bank, by the other banks, and also by Credit Suisse. So the main learning here for us is the supervisors have to maintain their holistic view on the entire bank and not only tick the box, yeah, this standard, this standard, this standard. And it reminds us that banks are complicated institutions. The risk profile of banks is very complicated, and you need a personal monitoring by the specific examiner of the bank on a day-to-day basis, apart of all the tools with ratios.
José Manuel, how did you, because for you it was kind of, they are testing the framework. How did you experience, and how did you, especially how, as you have been very active already and since 2008, how did you compare it with the time since 2008? Did you feel that we made strides forward? Did you feel that the regulatory instruments were at that moment, was the information okay, and was the framework strong enough?
Yeah, I mean, thank you, first of all. If I may, I like a comment on the title of the session. You know,
oh, yeah.
It makes me a little bit uncomfortable. It's like financial intelligence lessons learned in 2023, given that I'm on October 31st. I don't know if that gives me a right to go on vacation, or maybe we should have had this. We should have had this in February and see what we can learn between now and December. Let's hope that there's nothing to be learned.
Exactly.
I don't know. But let's
we're closed for business for crisis the rest of the year.
The reason why I say this is like if we had predicted. I mean, Credit Suisse was probably a little bit different, but if we had predicted 3 weeks before the Silicon Valley Bank situation where we're going to live, we probably would have missed it completely. You know, because it caught us by surprise. Certainly from a European perspective, it was something that caught us by surprise.
Yeah.
I would say, you know, well, obviously these banks had very little activity outside of the United States, but they're relatively little known. And it's not just Silicon Valley, Signature Bank also, and you know, was played an important role. So that tells me that it's important to sort of like always be on your toes, because crises may come from when you least expect it. Although then, when you think about the lessons learned, usually you come back to the basics, ironically, you know, because at the end, well, what was, you know, we look at what were the conclusions that were taken out from the investigation that the Fed performed, the investigation, the FDIC also came out with a report, you know, in the Credit Suisse case as well, there's been a number of reports, and the Basel Committee and the GHOS came forward. The end basically is like, first is, you know, lack of proper risk governance and risk management from the point of view of the institutions themselves, in some cases with very fast growth. In the case of Credit Suisse, probably also with an ongoing challenges in terms of the sustainability of their business model. Second, as Joaquin already mentioned, supervisory intensity and the use of all the tools that the regulatory framework puts forward. And then third, new developments that are happening in society, mainly driven by technology. This is this idea of the deposit, the speed of deposits, and the social media. And then as a result of that, maybe how do you incorporate that, or you need to incorporate that further into a regulatory framework? But since you asked me about regulation, I would say, this first, the lessons learned is let's make sure that we continue to have proper management, and the management should be on top of the risk. Second, think about supervisory intensity and maybe early action, more intensity, depending on the cases we can discuss. And then third, think about where the regulatory framework was helping or hurting. In this situation, was probably more helping than hurting. It was more, as I like to say, part of the solution of the problem rather, or the preventing of the problem rather than causing the problem. But there's technological developments and there's development there that we need to take into account and reflect on them.
May I ask you one short follow-up question, is because indeed we have always chosen, for instance, for the Basel standard, to implement it for all banks, where the United States has a different approach. Do you think that there was a regulatory change? So by looking, for instance, at 250 billion rather than 50 billion, that got Silicon Valley Bank off the radar and into an easier, no, I don't know if I say it right, but in an easier supervisory environment. Very concrete question: has Europe made the right choice to make it applicable for all banks to ensure that not everybody is, just not any bank comes under the radar?
Yeah, I mean, this is a very specific European choice, as you know very well. You know, the Basel standards apply to internationally active banks. It's a decision of every jurisdiction. Who do they submit, or who they put under those standards? In the U.S., as you know, it's only the largest banks that have been subject to that because they're perceived to be internationally active. The experience with Silicon Valley was internationally active, but relatively marginally in their activities. They were present, obviously, in the UK and other places in Europe as well, but with very, very minor operations. But then they turn out to be significant for financial stability. So I think there's a question, like, well, what's an internationally active bank that may be significant for financial stability worldwide, for cross-transmission of shocks? And that has to be assessed. We chose to implement it at all levels, and that's a specific choice of Europe. I think it helps us in certain directions. Certainly doesn't make the life of many banks easy, because they're very, very complex standards. We have some proportionality that hopefully helps in that direction. But I think it helps us also in building a single rule book, a single market. That project, the implementation of Basel, helps in that direction.
Yes, indeed, and proportionality is, of course, clearly aimed at reporting and not on basic capital level. Right. So I understand it very well. Sheila, you've heard two Europeans talk about the United States, and I've admired very much the FDIC in its, well, I would say, very clear and quick intervention when needed. So how did you look at the events at SVB now, more at a distance? But also, I found very significant the expansion of the deposit guarantee that happens, which was a bit of a chilling moment also for the Europeans. So how did you see it?
Well, I didn't agree with the decision. I don't question their motives. I think they did what they thought they needed to do. But I thought it would have been. I didn't think those banks, those regional banks, the two that failed, that were Signature and Silicon Valley, there were two that failed, were systemic. I fear that by declaring this a systemic event and all the headlines and attention that went along with that, unsettled people quickly. And then there is this politicized narrative around it suggesting that this was all caused by 2018 quote-unquote deregulation, which just flat out was not the case. Yeah. These banks were fundamentally mismanaged. Community-level supervision, community-level bank supervision should have caught it. They just weren't managing their interest rate risk. They grew quickly. Yeah. Heavy reliance on uninsured deposits. It wasn't hard to figure out they were going to get in trouble. So there is a process, and then there was this narrative. I think the optics around bailing out these billionaire depositors, especially at Silicon Valley, were very bad. There is another process the FDIC has at its disposal to set up a bridge bank, pay an advance dividend to uninsured depositors. That probably would have been able to be at least 50, up to 90% of their uninsured deposits fairly immediately, because they had good assets at Silicon Valley. And the estimated loss rate is going to be about 10%. So the point is, there was a process that could have set up a bridge, kept the bank going, paid an advance dividend to the uninsured, for the small accounts that actually needed the money for payroll. But then you wouldn't have had, the FDIC Deposit Insurance Fund taking an $19 billion hit to bail out, stablecoin reserves from Circle. So
Yeah.
I don't, and banks pay for that. So yeah, I was not, that's probably more than you wanted to hear, but I was not a fan of how it was handled. And then to go out and say now all uninsured are protected, they don't have the legal authority to do that. Only Congress is very specific about that. Only Congress can set deposit insurance limits. The only way they can do that is a bank-by-bank process, declaring banks systemic. They can't do that. There are going to be more failures next year, and they just can't do that. They're not systemic, and the Republicans will not go along. And they don't have the capital to support that guarantee either. So I've said, since it happened, I've said they should go to the Hill and get proper congressional authority. There's a streamlined process to be able to provide unlimited guarantees to transaction accounts, which is what we did during the Great Financial Crisis. We had uninsured deposit runs during the Great Financial Crisis. There is nothing new about uninsured deposit runs. We had a tool in place. It worked beautifully. We temporarily provided unlimited protection for transaction accounts. We didn't do it for CDs or high-yielding deposits. You don't want to do that. That creates tremendous moral hazard, because then the weak banks, well, hey, the uninsured are protected. I'll pay you 4 or 5%, whatever. I'll grow fast with the money these rich people are going to deposit in my bank because the FDIC is going to protect them. That's the kind of moral hazard you get with unlimited guarantees. So I do fear we've got the worst of all worlds now. So we have an implied universal guarantee of deposits. There's no legal authority to do that. There's no capital behind it. But you've got, to the extent people believe it, you've got the moral hazard and the ability of the weaker banks to continue to draw uninsured deposits with high yields. So I think there was a lot to be concerned about. And but it is what it is. They did what they needed to do. The deposits have stabilized now. It may be for the right reasons, maybe for the wrong reasons, but I do think there are going to be more failures. You can't not believe there aren't going to be more failures. And they've got a problem. I think they need to go, the Biden administration, the president has to initiate it, needs to go to Congress and ask for approval to do a temporary account guarantee the way we did during the Great Financial Crisis. It worked beautifully.
Yeah, no, it's again a crystal clear answer. I pick out two things. Is indeed, right. By the way they treated it, they almost made it systemic by the way of communication.
Yeah.
And indeed, the moral hazard that creeps in if you expand the system like was suggested. But picking up on notably on creating in communication systemic, and the way you communicate is already what I like so much about the FDIC, very crisp, very clear, very direct. Right. But I must say, and going to Joachim here quickly, I thought that Europe also communicated very well, because part of it was not regulation, it was not supervision, it was the right communication at the right time to calm the markets. I must say that Andrea Henry, single supervisor, Christine Lagarde, but also Chancellor Scholz were absolutely right in saying the right thing at the right moment, and that dampened it. Do you agree with me, Joachim, that communication has become so important in this TikTok time?
Well, it has always been important. Maybe the time lags between the events and the need to communicate are shorter, so you have less time to consider what you're going to say. But it's always their dilemma for the supervisors, for politicians as well, because you do not want to put at risk your credibility. So to say things are better than they really are. And on the other hand, you want to avoid to create panic. So it's always an offset between these two. And we Bundesbank rather tend to be to give a more realistic picture. Yep. But of course, in the European Union, it's again more difficult because there are many people who communicate. It is 20 national supervisory authorities. There are the central banks. There are the politicians. And what I appreciated very much was the self-discipline of the others not to communicate, as the leading figures were Christine and Andrea, and that worked very well.
I thought it was exactly an example of how it should be done. It was clearly well coordinated, because indeed you can create a lot of noise in this, but I thought it was well timed and well done. Now, quickly moving on to sticky deposits. That was a new discovery for me, because I found it very interesting that, for instance, if you take as an example Deutsche Bank, is that very high net worth moved around very quickly as expected, but that the average saver, the post-bank saver for Deutsche Bank, stood by its bank and didn't move anything. Now, so for me, it's interesting because also I noted also that analysts outside of Europe are now looking at European banks on the quality of their deposits, and I found that very interesting. Now, slightly controversial question, which you may see coming. If you are working on a central bank digital currency like the digital euro, with a cap of 3,000 euros, isn't there the risk that just for safety reasons, even though people trust their banks, that they would move their sticky deposits to a 3,000 euro wallet? And would that have any impact on financial stability, or would that just be managed?
Well, I think that could be managed. Of course, it is very difficult to assess how people will behave.
Exactly, yeah.
The threshold on 3,000 euro is not very high. And when you look at the average current account, there are not even 3,000 euro on the current account. Yeah. So there is no space for the ordinary consumer to move the money elsewhere. But we made some calculations. And the calculation is that when the full amount is exploited by the entire population, it's about 7% of the deposit base, so it's not really much. If it's only the online accounts, it's only half of it, and if it's only 50% of the online, so it diminishes. May I draw another, or may I raise another aspect of the digital euro as far in terms of financial stability? In the long run, the risks for financial stability are much bigger when the digital euro is not created. Because on the long run, all these money which is needed in the digital space, on blockchains and DLT, in this new transaction area, is not central bank money, but it's private money with its risks, and the central banks risk to lose their grasp on the monetary system. And this is one of the main reasons why the ECB now decided to start the preparation phase to not risk to lose its that the euro loses its function as a monetary anchor, with all the implications that you cannot fight inflation anymore, you lose control of everything. So in this, so here I would conclude to issue CBDC in the Eurozone would finally enhance financial stability.
Yeah. I thought that is very interesting, and if you think is, hey, am I at the wrong session? This, as Joachim clearly explained, future developments like CBDCs, but also like cryptocurrency, may have an impact on financial stability. And that's why, indeed, when Facebook announced Libra, all central banks in the world started looking at the idea of a central bank digital currency. But what's so interesting is different approaches. And Sheila, if I may come back to you quickly on this. The Fed has a completely different view on the digital dollar. They are more interested, I think, in a wholesale CBDC. Is that also because of lessons learned and stability questions, or do they just look at it conceptually different?
I think both. I think they look at it conceptually different. They're actually using a distributed ledger for the new Fed now for interbank transfers. There is a form of digital ledger technology. I think distributed ledger technology. I think it's important to differentiate the tokens, the currencies, from the actual technology. So yeah, I guess you could call that a form of CBDC. But there's a tremendous amount of pushback in the U.S. too from private stablecoin issuers opposing a CBDC, because I think it will interfere with the development of the private stablecoin market. And I think there's room for both. But I do think if you're going to have privately issued stablecoin backed by fiat like the dollar, there needs to be proper regulation around it, and there's not at this point. So, but that could as easily be used for blockchain transactions, et cetera. And with proper regulation, it should all be traceable. I thought the digital euro was interesting. I don't think 3,000 is nobody's going to be using that on blockchains. I mean, that the size of it's just not, if that's one of the goals. I think the more interesting use cases are wholesale, absolutely. International remittances, absolutely. For retail, it's more on the international side. Payments for retail domestically are very low cost and fast already. So to the extent you're trying to help consumers with a digital euro, it's not clear to me where the value add is for consumers. I do think for international remittances, for retail, for households, the world central banks could get together and have a more efficient way using blockchain technology to facilitate those transactions at much lower cost. It's outrageously expensive now for an immigrant in Argentina to be sending money to relatives in the U.S. wherever. It's really almost criminal how much it costs for our immigrant workers in the U.S. to send money home. So I think that would be a good place for a use case. I also think in the U.S., one of the things I've written about is government payments. We have so much fraud with our relief programs. You could see during the pandemic, we had to get a lot of money out very quickly. Had to do it, but there was a lot of fraud, predictably. And using smart contract technology and digital wallets to actually control where the money's going and what it's used for, I think has a tremendous potential. So I guess I applaud what the ECB is doing. I don't want to downplay it. I think they're moving ahead, and I think the rest of the world's getting ahead of the U.S. on this, no doubt. But the more promising use cases, for at least for households, for retail, I think, are in other areas.
Mm-hmm.
Yeah.
May I just add one
absolutely.
sentence in terms of financial stability? Well, of course, we have get used to the payment system for the consumers, and they are normally working. Yeah, but they have also their dysfunctionalities. You need 5 cards and PayPal and whatever, to settle every bill. With a digital euro, you only need one means of payment. And the payment in that system, it's much cheaper, because it does not go through to all the rails with the bank, with central bank money. It is much more efficient. It's faster. It's an immediate settlement, and by this, when the entire payment system is moved to CBDC, you extract the entire settlement risk out of the financial system.
It's real time, that's true.
And this would be a big advantage for financial stability.
No, there is. I mean, I say the Fed now is good because at least for the interbank part, you can have instantaneous transfers now, but there's still, now it's a mess because behind those very fast systems, there's a whole series of transactions.
But I agree that the innovative part is in the B2B
I agree.
and
Those are good points.
Sometimes I'm sorry that I'm the moderator because on digital euro and payment systems, I would love to have another panel. Jose Manuel, because that's one thing that will happen is indeed once we have a digital euro and you see expanding, and anyway you see the financial system expanding to non-banks. And for me it's very important because, as I always remember when I was a child, I used to have a model train and I would use rails, and the more model trains I put on for some time it would go well, and then I would have an accident. And this is a parallel with the banking sector. If you have many non-banks, unregulated, unpredictable, then don't you think we may have an accident, and will you please help us prevent it?
Well, I mean, I think the challenge that you put goes way beyond the introduction of the LTL2 technologies, right? I mean, non-bank financial intermediation is already a big part of finance in the world, which is probably the number one area of focus and concern right now. It's like, and partially has been developed due to the regulatory the regulatory position that has been taken after the global financial crisis, and we need to make sure that that's not regulatory arbitrage purely, and that the risk that's been transferred to a non-bank financial intermediation sector is properly managed, and at least it's not systemic, and really have a big black hole there. So that's one area in which I think, in the short term, in the medium term, is probably the number one area of concern for financial stability. Now, think about technology. In the context of the European Union, we're also regulating the private issuers of asset reference tokens, so private currencies for MiCA, right? And that's one issue that is back to the EBA, that we have the mandate to regulate that and supervise the critical ones starting in 2025. My sense is that, this is a situation which, okay, well, we figure out finally that there was a technology, and after the technology, there were use cases that were maybe worthwhile pursuing. As a result of that, therefore, did a regulation. That's the case for this asset reference token. You put the regulation out there. Let's hope it works. Part of the challenge that we have going forward is that we are regulating and expecting to supervise a universe that we don't know.
Yeah.
We don't know who will be issuing them and how popular they will be. And many of it is obviously contingent on obviously what the central bank does as well. But I think at least the guardrails for having these products coming into the market will be in place, and it will also help distinguish between our asset reference tokens and other type of crypto activities or crypto assets for which the business case may be more questionable, I think.
I see it also broader, and I would like, Sheila and Joachim, your view on. It's not only, say, you have the rules. It's not only you get a banking license and you're in. That's the easy part. It is, and both of you have a long experience with it, is live supervision. I will tell you an anecdote from the Netherlands, where we had a challenger bank in, and it went bust in the financial crisis and caused huge outcry. And the interesting thing is that I remember that there were norms, and if you don't know the norms, you don't know what's happened. I was working at that time the largest European bank, the Dutch bank, and when the central bank the president of the central bank would call my CEO and say, "I would like you to come in for a cup of tea," then there was total panic, because that was code for something's very wrong in the way you conduct your business, and you have to rectify this. This challenger bank was called in for a cup of tea, had no idea that a cup of tea was something else than drinking a cup of tea. And in his biography, he wrote, "I was invited for a cup of tea, no idea what they wanted, but I didn't even like the tea." And the point I'm making, and that's why I would like both your comments, is that if you have new challengers and you've done everything well, you have the regulation well, they have a banking license, if they don't know the unspoken norms of supervision that actually keeps us safe, that through you, both of you, then you still run a risk. How are you going to deal with that? Joachim, may I start with you? There's the handwork of supervision.
It is a question of the learning curve. And we have lots of neobanks and other companies in Germany, 7 unicorns in the financial sector.
Exactly.
And we have our conversations with them. And the difficulty is not that much that they don't have the knowledge. They can buy it anywhere,
exactly.
But they come from an entirely different planet. They come from technology. They don't even know that a bank can be brick and mortar. They are native in the internet, and they have not the education and not the culture of a supervised bank. But we have, of course, our instruments to make them learn and to accelerate the learning curve, and that's over the years. I think it's working well. And when I invite one of these CEOs of one of these internet banks for a cup of tea, they would come and they would be as alerted as the chief of Deutsche Bank would say.
Sheila?
Yeah, I don't think
you know all these people, because again, I have a friend who says, "I can code anything. Supervisory problem? I'll code it in 10 minutes." Yeah.
Well, I don't think we do the cup of tea thing in the U.S., but that's kind of nice. I mean, I almost wish there was a more direct communication from supervisors, because you're right. Some of these new banks and some of the fintech-oriented ones, of course, a lot of that in the U.S. is done through partnerships with more traditional banks. But some of these fintechs have acquired their own banks, and they don't get it. And that may have been a bit of a problem with SDP. It was a relatively new, rapid growth bank, very hip, very glamorous, all these billionaire venture capitalists. And so they probably thought they were a little better than the supervisors when the supervisors were trying to point out their opportunities for improvement. So, but look, I think it's important, is a part of the charting process. You need to make sure there's experienced management. At least with the FDIC, always had to approve even if we weren't the primary regulator, we always had to approve the deposit insurance. We would always take a good look at management and boards to make sure there were some legacy bankers, one or both places. At least that's the way it used to be just for that reason, that they needed to understand what it meant to be a supervised entity. But yeah, it's a challenge for sure.
I may add an anecdote too, because during the pandemic, we lost the contact to the banks. Where there was no such conferences. We didn't really even know what's happening on the ground. And then I randomly called CEOs of German banks just to have a talk about what's going on and what are the issues and so on. And I caused that panic, because
Why are you calling?
I just want to talk about the situation of and then at the next call we said there's no agenda. That caused even more panic.
Yeah. Actually, it sounds indeed brilliant. Say, board member of the Bundesbank calls you and says, "I have no agenda." That would scare me so much. No, but it is true, and that's the point. So now, going to and I'm going to ask all three of you, starting with you, Sheila, if you look at this financial stability, the lessons that we take home. Indeed, for me, it was one. Yeah, if you have a regulatory system, use it to supervise.
Right.
But I'm very interested in which three lessons would you take home from the March event that will make us better able to deal with the future? And I'm going to ask all three of you and then open up for questions.
So I guess first of all is people can get complacent when you have a protracted period of relatively benign and operating environment for banks. I ran into the same thing in 2006. The examination process has been brutally cut back. We had to reverse course, hire up, train people very quickly. So I think there was some of that. People just gotten a little complacent. But, finance is a cyclical business, and when it turns fast. You always need an alert, engaged, well-resourced, well-trained examination force. These rules aren't worth anything if the supervisors aren't enforcing the rules. So that's one. Number two, government securities are not risk-free. They are not liquid in a rising interest rate environment. Okay, so that kind of fundamental, people forgot that. The rules, as you alluded to earlier, the rules still treat them as, at least our stress tests, risk-free and highly liquid. So Silicon Valley Bank probably would not have had any problems with the enhanced test. And then, finally, there is the risk of contagion. It has to be maintained, but I would agree with your very first comment. Good communication around that, and I still believe that Silicon Valley could have been put into a bridge with proper communication. Yeah. We had to close a lot of banks during the great financial crisis. We contained deposit runs. Deposits were actually going into banks, but a lot of it was just all about the communication strategy. That matters too, and that may be a lesson that's been forgotten that needs to be relearned again now.
No, that I absolutely agree to. Yeah. By the way, there was a large bank that recently tested its dealing room, stress tested its dealing room, on which of their young dealers had lived in a high interest rate environment. And I think 70% hadn't. So that tells you something about life experience and banking. Yep. José Manuel, which three things do you take?
Yeah, I mean, I only have two, because some of them were already said by Sheila, so I have only got two. But one, which comes back to my initial remark about the title, is that we need to be very careful and realize that we're going through a period in which we've risen interest rates after a long period of very, very low interest rates very quickly and relatively a lot across the world. And that's a repricing of assets across the world that we cannot be complacent. And accidents are prone to happen. And to be honest, I'm amazed that so far there's been so few accidents along the way.
Honest, and a bit of a slow train crash.
To the sovereign bonds not being risk-free is one example, but there are many others out there, and they're likely to come up, and there's likely to be excess leverage across the system, and we need to be careful. That hopefully will not be on the banks, but that's one lesson. And then the second one is that I think that this was very clear with the Silicon Valley experience, but I think it's a broader intuition that we all have, is we have this inherent contradiction. In one extreme, we're pushing, when you talk about technology, we're talking here for half an hour, it's all essentially about having instant payments 24 hours a day, 7 days a week. And then as you walk throughout the channel of how liquidity gets provided, and how you assess solvency, then you get to a far end in which, at the extreme case, you have resolution, in which they tend to think constantly. The FDIC tends to think about getting to the weekend So they get into the weekend. And we know there's no weekend
anymore.
We know there's no weekend now, and you know, in the case of Europe with Popular here, it was during the week, and that was already, but it was at night, and Silicon Valley was during the day.
Yeah.
So that's something that we need to think about. You know, how we make that channel. And when we think about the liquidity, it's the same thing. Yeah. You know, there's always hear about these banks. So they have collateral, but they not have it ready to go to the discount window. Or the discount window, depending on the central bank, opens between 9 and 11 on Mondays, or Monday to Friday. You know, and that we need to think about how we're going to stream that line. You know, it's always been the essence of banking, right? You provide side deposits with illiquid assets, but as we push technology, it's just getting more and more tense, and we need to think about how to fit the regulatory system that's solvent and then at the same time provides sufficient service to society.
The lightning speed, indeed, of payments in combination with liquidity, and if something goes wrong in that liquidity, then it ends there and then. Joachim?
Well, first of all, I would say the regulatory framework usually works, but it needs to be properly implemented. And as I said before, the judgment of the examiner is decisive. Yeah, that he takes an holistic view. Well, but of course, some of the ratios and some of the details have to be adjusted, like LCR calculation or and these kind of things. We can also take from this that you could see the limits of supervision in this case, because when trust erodes, supervision can nothing do against that. Yeah, and no ratio helps with that. There's a certain aspect of irrationality also in these kind of development. And third is that in times of so big geopolitical, geoeconomical uncertainty, the contention risk for the whole system is very large.
Yeah,
it's very big.
I agree, and again, the trust issue that you mentioned, that's why I was so impressed with the very well coordinated communication, because that's the only thing you can still try.
No.
I have a question from the room, sir. And there is somebody running very quickly with a microphone.
I would like the panel to comment on four possible responses to
the microphone is not on. That is also.
Maybe I'll shout. I would like you to comment on four possible responses that have been put forward, mostly by academics, in response to the U.S. failures of this spring. First, unlimited deposit insurance. Joachim, you know that some people very prominent from the University of Frankfurt have been advocating this. Second, substantially raise capital and liquidity requirements to make the banks stronger to withstand the shocks. Third, mark-to-market all tradable assets in the banking book. And finally, expand lender of last resort facilities so that solvent banks can access liquidity from the central bank to withstand runs. So these are four proposals I would like to.
Yeah, take your time, please, answering these, and I will do the task of doing the undiplomatic, giving you the undiplomatic answer. This is clearly thought out in a laboratory, because listen to Anna, there is no world without risk. This is describing a Volvo which you put in a garage and you lock the doors. It will be very safe, very beautiful. It won't get you anywhere. So that's the undiplomatic. So Joachim, now the nuanced answer.
Well, maybe not each panelist answers to each of the proposals. That could make the things a little bit easier. As far as deposit insurance guarantee is concerned, I entirely share the view of you that this would not be a good idea, because the moral hazard issue is that prevailing. Mark-to-market is of course an option, but when you want to hold your assets until maturity, there's no argument for a mark-to-market assessment, I think. So this, from my point of view, is fine. Access to central bank money is a very big issue and raises lots of questions, which I think our occasion will be overstretched if you start here. Also for non-financial institutions. For others, there are movements in the UK at this moment. So this is a very difficult issue, which raises fundamental questions about the mandate of a central bank.
Yeah. Absolutely. Well, I'm biased here. I'm agreeing. Sheila?
Yeah, so what we addressed, I would agree with all that. Just one caveat on the mark-to-market. I mean, yeah, that's really what makes you a bank, is that you can maintain that stability in your valuations. I would, with one caveat, one issue in both the Europe and the U.S. is the treatment of underwater securities for liquidity purposes when they're held to maturity. So right now, you pretty much get full credit, even if they're deeply underwater. I do think the liquidity, or regulators should at least consider revising the liquidity stress test so that if you're going to count your HTM, that you're going to post a collateral, whatever, it has to be marked down to current market value. I do think that's one area where we could expand mark-to-market treatment, but that just for the liquidity stress testing.
Yeah, no, that's absolutely, that was going to be my point. That's actually the regulatory regime now in Europe.
Good.
Mark-to-market, for liquidity purpose, you mark-to-market your hold-to-maturity assets. So when you think about LCR and all these areas, for other purposes, you might keep them held-to-maturity, but you have to mark-to-market them. I think that combination with the fourth one, so you can deduct that from my comment before about making sure that you go from instant payments to having access to liquidity windows relatively efficiently. I think we need to revise the whole process. As I said, making sure, obviously assets are always mark to market, but not only mark to market, you know exactly where the collateral is, what the processes are, what you need to do exactly. You stress test that to make sure that you have the ability to get to the discount window and to get the liquidity as soon as possible. Because many times banks, and this happened in Silicon Valley Bank, it happened in Popular, it happened in many resolution cases, they think they have collateral, and then when something hits the fan, they don't really have the collateral ready to go to the Swiss to the window. Exactly. And the window may not be open because the central bank only opens at 9 to 1.
Yeah, and maybe the central bank is not even willing to give them money anymore because the situation is so bad.
Exactly.
That's right.
Yes, I can't help you with the last question, even though I have to tell you, until 2 minutes ago, nothing was happening, and then suddenly a huge stopwatch that stopped appeared in front of us, which I would ignore, but also I see the lady director of the protocol there, which makes me nervous. But Alejandra, please ask a quick question, and I'll allow for a quick answer.
Thank you. I don't know if it's a quick question, but connecting also with the debate earlier this morning, is it feasible, reasonable, in your view, to work towards a regulatory framework that combines security and confidence and the very secure Volvo with the agility, the competitiveness, and the growth that we need in Europe, coming also from the capacity of our sector to support the real economy?
So is it possible to design a Volvo 850 T5?
Well, indeed, you're alluding to an issue which will maybe become even more important in the future because in terms of transition of the whole economy, banks and financial institutions need to take more risk and higher risks. And that can be only done responsively if the traditional strong supervision keeps these risks contained.
So, yeah, I think you can. I think you should. That's what you should strive for. Banks, getting back to earlier, banks should be allowed to fail. If you want a dynamic system, if you want to let banks should be able to take some risk. And because that's how you get a more dynamic economy. So, no, you don't want them to just be so battened down that they never take any risk and they don't do much to promote economic growth. So you need to let them, and they're going to fail sometimes because of that. Yeah. What you need is a process to limit the contagion, a clear process, follow your rules, communicate clearly to people what's going on. And I think that's what you do. My fear is that we're going more towards the knee-jerk response is bailout. Okay, if there's a little question, let's just bail them out. Let's just put some government money into it. And that eventually is going to, the supervisory response to that, you're probably already feeling it. We certainly are in Europe and the U.S., is to just tighten down even more, because there's such huge, embarrassment and public scrutiny and outrage when government money is put in to bail out failing banks. So that would be my ideal. And but I fear we're migrating away from that, not trying to preserve it.
José Manuel?
No, very much agree with what has been said. I mean, we need to allow banks to fail. We need to allow them to fail in a way that is not dramatic. In Europe, we made the choice to say no taxpayer money in that bailout, or that failure process. There should be bail-in. That's costly for the banks as they go forward. And this is maybe costly for the system because it requires, but ironically, we haven't used that money. So we build a single resolution fund, we have the deposit guarantee schemes pre-funded, and the whole point now is let's use them to let them fail so we can be more proactive in creating, my favorite expression, creative destruction.
And by the way, the Volvo has evolved as well.
Yeah. Yeah. We will talk about which model I like most. Ladies and gentlemen, you have chosen the right breakout session because...
But thing is, they have no way to test the other ones.
The Volvo has managed indeed the crash test, and the lessons are very clear. And I thank Joachim Wurmeling very much, and José Manuel Campa and Sheila Beer, because they've given us unique insight about how we dealt with the crisis in a new world. Also, how technology needs to make us vigilant for the next crisis because it will come from there. And also, indeed, how it should be a hygiene factor of banks to fail. But the end is, if we want to compete for growth, we'd better build a car that is both strong but also agile. Thank you very much.